Hi, I'm Steve Van Metre. It's Monday night, where we take 15 minutes and try to make sense of what is going on in the stock market and the economy. Well, first up, we've got trade wars, followed by quadruple top in the S&P 500. And last, we've got to make sense of what the Fed was trying to do last week. So we've got this trend that's really been building since December, where someone from the Trump administration, could be the president himself, and I'll just say this straight out. I don't think the president of the United States, and I'm not picking on President Trump, or I'll say this across all presidents, they really should not be pumping the stock markets or trying to. They need to focus on whatever their job is and let the markets decide what needs to be going on. But what we have seen now is a president who has staked his reputation on the stock market. And as a result, Friday before market close, this is becoming a routine deal where someone from the Trump administration will talk the market up if it's not rising. And then Sunday afternoon, before the futures markets open at 3 p.m. Pacific, they're out there, 10, 20 minutes before talking about, how so close to a trade deal. Now, we've been close to a trade deal for 4 months now with no real change. And the market doesn't know whether to believe it or not. I mean, this is kind of, you start wondering, is this, the boy who cried wolf? Is there really a deal or is there not? And when there is a deal, will anyone even care anymore? I don't know. But nevertheless, the computer algorithms that read the news and tweets and whatnot and make trades, they like this. They love anything to do with this trade war might be over. Up goes the market. And, so the futures market went up in overnight trading only this morning to see the market start to go way down. And what happened is the market opened, it hit up to, I want to say 28.16, which is right in the top end of this quadruple channel between 28.20 and or 28.16, 28.20, somewhere right in there, and 27.90 on the S&P, which is a heavy resistance zone that not once, twice, 3 times, but now 4 times prices have been rejected from going higher. That's called resistance. So, it normally doesn't take 4 times for the market to say, hey, we've had enough here. We're going to sell. And sure enough, the market did, fall from there. And then in late trading, it rebounded back. Now, what's so special about this level? Well, it just could be where the big players want to sell. It also could be, we have a market that is being driven by corporate share buybacks. And everyone thinks that, corporate share buybacks, the market's going to double, triple in value. Yeah, that's not quite how it works. It's very simple. So let's say a company has $1 million. We'll use a small number because some of these companies have announced tens of millions of dollars, $100 million buybacks, $1 billion buybacks, just big numbers. Let's say they're going to buy $1 million worth of shares. Well, if the shares are priced at say $10 a share, they can buy a lot. Well, if they go to 20, they can only buy half as much. And then at 30, a third as much. And that's the problem. As prices rise and the amount of money available to buy buybacks is decreasing because they're buying on the way up, you get to a certain point where you can't buy enough shares to make a difference anymore. And that seems to be around this $2,800 or 2,800 point level on the S&P 500. There's a second issue here, is that corporations can only buy back a quarter of their average daily trading volume. And I've done some digging. I can't find the exact length of how far back they can go. But as they can buy less and less, and mind you, they are the marginal buyer of stocks, as they buy less and less, well, volumes slowly drop. Well, if volumes are dropping and they can only buy a quarter of the volume, well, eventually they run out of steam and they need the markets to drop so they can try to buy some more. Of course, at some point, they're just going to run out like they did in October of last year, they didn't, I wouldn't say they ran out, they just didn't have as much as they did, and the market drops, and that's what's going to happen again. And if corporations keep up their pace of buybacks, well, they're going to run out of money by the end of May. And we know what's coming after that, if not sooner. So the other issue is what's been driving up Treasury yields. If you missed my Facebook post, I'd take a look back at that. But it turns out to someone on Twitter, and that's one of the reasons I love Twitter, not because I post on there, although maybe someday I will. It's because there's so many experts on there. It's kind of where the financial community has gone to talk, because there's nowhere else for them anymore. I mean, a lot of them are not working at major banks anymore. They're kind of just filtered around the country or world in some cases, and they come to Twitter to talk. And one person pointed out, hey, this was called a reverse repo by the Fed, and I verified the Fed does reverse repos all the time. And in this case, it looked a lot like quantitative easing, where someone either needed to borrow some money and they went to the Fed. So the Fed said, I'll take some of your treasury bonds as collateral and here's some money. So it does look like quantitative easing, even though it is not quantitative easing at all. Or it just could be the Fed was needing to try to control interest rates, and they use reverse repos to do that by saying, hey, well, we're going to take some of your treasury bonds and we're going to pay you interest on that. And these reverse repos can last overnight, but no longer than 65 days. And according to the Fed website, the most common length is 15 business days is how long it has it. So what happened last week is somebody needed $117 billion and they went to the Fed to get it. Now we know, of course, who are these people? It's the securities dealers. It's not you or I or a corporation that's going to go do a reverse repo. It's a securities dealer. So what we don't know is, did they really need $117 billion because there's a problem, or is Fed trying to control some movements of interest rates and they temporarily needed to do this? We don't know, but that's the catalyst. And at some point, obviously, these reverse repos will mature and those treasury bonds will go back to the owner. The Fed doesn't own them. They're just holding them as collateral. So that explains what's going on with the treasury market. There's still a massive amount of short interest on it. So the reality is, this isn't this big hoorah that yields are now going to finally go to 5-6% like everyone has been talking about. This is just the Fed doing something the Fed needs to do. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by or selling security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Finish the rest of the video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. Now, if you don't understand what this reverse repo thing is, and don't worry, I don't really understand it much either. I had to do quite a bit of research this last weekend just to get an idea of what it is. Now, why they're specifically doing it, they don't need to tell anyone. They're not beholden to say, hey, we had to loan, Bank XYZ $117 billion because they were getting margin called or squeezed on some of their trades and we needed to provide liquidity. They don't have to say why. What we do know is they hold around $250 billion worth of these reverse repos at any given time, at any given year. And that's all we know. So, but we do know by doing a reverse repo, it puts liquidity back in the market, especially when you have a sizable one like that. And that does temporarily cause interest rates to go up. And as we'll see today, when we get to the charts, they started to come right back down, which is not really a big surprise. So let's go spend the second half of our time and flip through some charts and see if we can make sense of what is going on in the market. So let's start with the S&P 500. We have got this beautiful quadruple top. I mean, we can go farther with that and say it's actually much more than a quadruple top. It goes way back. Let me fix my charts here real quick. And it goes all the way back, as we've looked at, to January of 2018. And we can see it's not just been directed once, twice, 3 times, 4 times, but you have 5, 6, 7. You can say this could be a rejection of 8 here. So you can see this has been an area of a heavy resistance where sellers just can't get through. And in the brief times they do, the brief time the buyers get through, the sellers come back. So this is real strong. And it's surprising to me that we've needed to go back to here so many times. And it's probably due to corporate share buybacks. And this whole rally here was based on 3 factors: double the rate of corporate share buybacks as last year, the quant computer programs buying, the risk parity programs buying, and based on the data that we can see, the quants are all in, the risk parity programs are all in, and the only question left is, well, what kind of buying power do these corporates have? And when your price goes back up to a spot where they haven't been able to breach, you start looking at volume and say, well, if you can only buy a quarter volume and volume's already low, like let's look at historically. I mean, if volume was way up here, the corporates could buy a lot, but volume is low, and you can see it got really low right into here and just kind of fizzled out as the corporates ran short of money to continue their buying pace, and that is expected. They're buying their stock so their executives can get out. And right now, we are actually seeing the largest number of executives quitting their jobs since the last recession. In fact, the number are leaving that are more than the last recession. Now, why would, if I was an executive of a big major corporation, why would I want to leave if things are so good? Well, one, I know things aren't that good. Number two, I've got real-time data. I know the sales data. I know everything. How many customers are walking into my store, coming to my shop, what they're buying, how they're buying it, how much they're spending, how that compares to the past. I know what my inventories levels are. I know everything about my business. And I also know how much stock that I've been granted by my company. And there may be limitations of how fast I can sell. But when I quit, I can sell it all. And think about that. When I quit, I now have no restrictions. I can sell. And as long as I've told an investment bank and said, here's a couple $1 billion to buy stock back, and then I call my financial advisor over there and say, hey, sell my stock as the company's buying, I can get all my money out. That's what's going on. All right, so let's go back to the charts. Let's take a look at the 10-year Treasury yield. So here we see it bounced up last week due to the Fed's reverse repo, and so that's not a major deal. People look and say, "Oh, it broke the trend of the 50-day moving average." Look, if you've got the Fed running some sort of operation to do something, and that causes it, that's not the market. That's the Fed doing a short-term move. And since their typical reverse repos only run 15 days. Well, then we have an idea that some of this is going to be brought back at some point whenever the short-term loan goes away. So this is still, a very bearish pattern for yields heading lower, especially since, as we know, banks have been buying U.S. Treasury bonds in droves. Let's take a look at physical gold, see what it's kind of been up to today. And it came down. Again, we're expecting this thing to drop somewhere around this, say, 1240, 1250 level. Could it get down to 1200? Sure, that's not impossible. So we're looking to see where this goes, and if it firms up around 1200 again, then that tells us this is where the big players are at. That's what we want to know. Where is the big money at? And we don't know, because this run, and then as we switch to the gold miners, I can tell you for a fact the quant computer programs were bought this move up. And I believe the risk parity people also were involved in this. So what we're seeing is, and speculators as well. I mean, from the people I read on Twitter, there are people that are, taking, stabs here and there, using call options and whatnot to take a speculative move here. What we want to find out is where this comes down and where does it hold. If it holds somewhere, say, anywhere between $20.50 and down here in this bottom range of, say, $18, that tells us where the smart money's been buying. They've been buying here, and they've been waiting to flush out these computer models and speculators so they can buy some more. That gives us a tremendous amount of information. Let's take a look at oil and gas producers. They're kind of just going in sideways action again. Based on all my information, these are headed lower. And I mean, it makes a lot of sense when you're seeing, South Korean exports fall, Chinese exports fall, Japanese exports fall, Asian exports, just lump it all thing together, falling. How is that demanding for oil? I mean, how is it that the United States can just grow like crazy when the rest of the world isn't? We can't. We had global synchronized growth. We're going to have global synchronized downturn. What we had was global synchronized money printing from the central bankers, and due to the Fed's monetary tightening and that we're the world's reserve currency, yes, we already know that world trade, because world dollar liquidity is going down, that world trade has to go down. And yeah, that's going to affect us at some point. And I believe we're going to see it when the first quarter earnings come out, because the retail sales data in December was not a fluke. There's been multiple data points now that have validated this. Not a fluke at all. One thing that still is baffling with farmers filing foreclosures on their farm at the highest rate in 10 years. So there's an issue. How do you deal with a supply problem or a perceived supply problem? Well, one, you can use up the supply, or number two, you can take the supply out of the market, use it up, burn it up, destroy it, something. You can get rid of it, clearance it out at lower prices. Seems like what we're doing now. Another way to deal with supply is put the suppliers out of business. And it's interesting to me because I watch the Asian markets, up until I go to bed, and they're buying agricultural commodities because they're cheap and they need them. They need them. They do not have the land, the water, or the ability to grow crops like American farmers do. We are literally second to none. As soon as Americans get into the office and start trading, they're selling. They're shorting the sector like crazy, and it doesn't make any sense. are they really long and they're trying to just put as many farmers out of business so price will shoot up? I mean, I don't know. But all we do know is the weather patterns during a solar minimum are not conducive to crops because our hybrid crops are designed to grow in optimal temperatures. I mean, they have been just optimized. I mean, down to practically the day and how long they're going to be in the ground and what they're going to do. It's all been optimized. So you start throwing colder weather into the mix, it doesn't work. But nevertheless, this sector is completely battered down. Traders are buying. We saw this nice big volume movement. And when you see big volume, I mean, it's not the hugest volume, but it's big volume. It's either starting or stopping. So it's either starting trend, stopping trend. But my guess after this thing has been battered down since this last move back, I mean, you have to go all the way back to here to 2011. And we're right in the middle of the cycle of where the solar minimum is. At some point, this has got to come to an end, and we ought to see a rally there. So I think we should just, sorry, there we go. Here's our little 2011 rally, but that wasn't the big one. The big one here was in 2008. Add 11 years to that, which matches the solar cycle, and you're right where we're at here. So the odds of crop prices going to zero, well, it's not possible because crop prices can't go to zero. They unless you and I and everything on this planet stops eating, it's not going to happen. So we know this will turn around. We know every 11 years it has, and it's just a matter of waiting game. And with all these short sellers, it will be a point where they get flushed out, and that will be a day that I'll be pretty happy about. All right, I'm Steve Van Metre. Just so you know, for those of you watching, my wife is having major surgery tomorrow on Tuesday. Office will be closed, and you should just assume it's going to be closed most of Wednesday, even though I will anticipate being back maybe at some point, depending on how her procedure goes. She'll be in the operating room for probably about 8 to 12 hours. Pretty major back surgery. So thank you for all your well wishes and prayers, and hopefully I'll have an update, a really good update on her for you, as long as a catch up on what's going on in the markets and the economy on Wednesday. So I'm Steve Van Metre. Good night.